I'm going to give you 2 reasons why you should buy long-term care insurance.
And I'm going to give you 2 reasons why you shouldn't buy long-term care insurance.
So with the aging of America, Jason, an issue that's come to light, especially with the sandwich generation, which includes me, the sandwich generation being I'm raising children, okay, but at the same time, I have to tend to the needs of my parent, okay? One thing that's come to light is what happens when I get that age of my parents, okay? Who's going to take care of me? I don't want to be a burden to my children, okay? So something that's in planning has become very heavily considered these days is long-term care, and how do we address that issue? Because the reality is that, when you hit 65 years old, about 70% of those people, that generation, that age group, will need some type of long-term care assistance, okay? And when you need that, and that happens when you can't do defined legally as 2 out of the 5 EDLs, assisted daily living activities. That means I can't cook for myself, or I can't dress myself, or go to the bathroom for myself. Those types of situations last about 3 years, okay? And we're all getting older, right? So what do I do to make sure I'm not a burden on my children? And Jason, explain to us, there's usually three different considerations when you hit that age or that stage in your life.
Yeah, so you could have home health care. So a lot of people want to stay in their home. You can have a nurse come into your house and take care of you from that standpoint. That's one. And on average, that would cost right now about $60,000, $61,000
a year.
A year.
Right.
And then you could go to an assisted living facility, which they provide all types of help. They may cook for you. They may do some type of nursing needs, things like that. Now, that may involve you rooming with someone else, and the average cost on that is $54,000. Or you could have a private nursing home room where you have your own room, and that on average right now is around $108,000.
Right, and these are just, again, choices that will depend on a couple of things. One, your finances, which is what we're going to talk about now, but also your comfort level. In home, well, very not disruptive, rather. Yes. Okay, you're staying at home, someone's coming to you. Assisted living, a little disruptive. You still have flexibility. Sometimes they let you come and go if you can still drive, but they'll cook for you and maybe do some laundry. And then the last one, which is obviously the nursing home, which is a lot more restrictive. You're staying there, you're living there because you have to.
Yeah.
Okay.
No, as I say, there may be like a memory care issue where, you really need that extra help because you could get lost or you could go somewhere and, not be able to get back home. And there may be extra costs and things involved.
Typically with the onset of Alzheimer's and diseases of that nature.
Yep.
When you see these options, one thing that comes to the forefront is they're all expensive. Okay, yes. I mean, think about spending $50,000 to $100,000 a year just to make sure you can live, just basic living. So it's something you should start thinking about early enough, okay? And one of the ways that people help supplement some of these costs is what's called long-term care insurance, okay? So I mentioned that I'm going to talk about why you might want to consider it. If you don't have that level of money or those assets to be able to self-insure, pay for it out of pocket, well, you might want to consider a policy that allows you to insure yourself over time, small pieces at a time. Okay, so that's one way, and the way a long-term care insurance policy works, it helps you pay for those costs. I'm going to get a little deeper into that, but that's one time when you might want to consider, maybe I need some long-term care insurance because I can't just pay out of pocket, out of my own assets on this. Another reason to consider it is simply, I don't want to be a burden for my children, and I want to make sure that they don't have to pay for it, and I'm taken care of. They're not going to take care of me, so it'll let me sleep at night knowing, you know what, if and ever I hit that stage, I'm covered. So those are 2 fundamental reasons why you might want to consider getting some long-term care insurance.
That's right. And here's a couple reasons why you shouldn't. The first one is not an ideal scenario, but you just simply can't afford it. Right. So in that scenario, if you're doing a financial plan, you're looking at someone's assets and looking at their income, and the cost of that long-term care policy would drain their assets where they would run out of money too early on in life, then in that scenario, you shouldn't get long-term care insurance. Right. Now, there are certain things, it's not, again, the first option, but you could potentially qualify for Medicaid. We're not going to get too much into that. But again, that's not what you shoot for. That's not the goal, but that could potentially be a backup plan. So the other thing is to think about why you shouldn't buy long-term care is the mindset of maybe I could self-insure. Like instead of paying for these premiums over a long period of time, what if I just set aside an account and saved up and built up my own level of an account with money in it to be able to pay for that? And I'll get into an example of that at the end.
So as we move on to talk about should I do this or not, okay, because I think we've presented both reasons of why to and why not to, okay? You have to understand the nature of how these policies are structured, which allow you to have some further elements to consider on whether this makes sense for you or not. So let's learn first how long-term care policies are structured, there's a lot of moving parts to this, and there's two different types of long-term care policies. They're what are called lump sum policies, where you drop in maybe a couple $100,000 and that guarantees a certain benefit. That money kind of grows there at a certain minimal rate, okay? And then it allows you to use that for long-term care, and it also allows you to use it, if you don't use it for long-term care, you just die. Well, it becomes a death benefit. And several policies of this nature also allow you to, if you don't need the long-term care, take the money out, okay? Now, the money hasn't been growing, but at least it's still somewhat liquid if the policy is structured right. So that's the lump sum if you have a few $100,000 to throw at this thing. That's upfront funding. Not everyone has that. So they are what are called the monthly premium approach, which is instead of doing a lump sum every month, they'll quote you a price every month to pay for a certain benefit amount. Right. Okay. Now that leads into the different elements of the policy, which is what's the daily benefit amount. Okay. So it says the cost of living of a nursing home or assisted is $200 daily benefit amount. So that policy will provide that much for whatever type of structure you want, assisted living or nursing home. Okay. So that's one of the higher the daily benefit amount, the higher the premium, right? Another one is how long you want this to take place. You could do it for 1 year, 2, 3, 5, 10, lifetime, okay? Obviously, the longer the duration, the higher the premium, and vice versa, okay? Another one is, do you want what's called an inflation protection clause? So some people say, okay, I'm going to have that daily benefit amount that will add up to $165,000 or $200,000 of total benefits, okay? Well, if you lock it in when I'm 50, well, 200 today is not 200 in 30 years, okay, or 35 years. Some people are okay with that, but some people say, no, I want to make sure it's the 200 then, okay, future value. So you can have what's called an inflation protection rider, which will increase the benefit by 3%, say 5% every year to take care of some of the increasing costs of healthcare. Well, that's going to make it more expensive, okay? So again, another lever. And then another issue is elimination period. If you have some funds, if you've done some good planning, you can say, okay, if I need a policy, if I need to go into a facility, I don't want the policy to kick in till 30 days after I'm in, or 60 days or 90 days, okay? That's called an elimination period. You can play with those levers. The longer you wait for it to kick in, the lower the premium, okay? The higher, or the quicker it kicks in, the higher the premium. So those are the basic elements of the structure of a long-term care policy. A couple of things that take place in calculating the premium that you get quoted is your age. Yeah, and if you do a joint policy, you're in your spouse's age, okay? And your health, okay? So these are different elements of a long-term care policy that make it a little bit complicated to figure out. And sometimes you're saying, well, do I need this much? It's kind of like figuring out, how much do I need on a car and what's my deductible? And like, well, there's no right or wrong necessarily. It depends on your financial situation and how risk-averse you might want to be. But they're important to consider because one of the biggest deterrents to long-term care insurance that you mentioned is affordability, okay? Can I afford this? And there's different ways to analyze that. When you do a financial plan, there's the ongoing insurance cost to make sure you implement this before you need it, okay? But then there's the cost of after you need it, okay? And these are two very important considerations. One knockout factor, which we talked about before, is if I barely have enough to live off when I retire based on what I'm putting away into my Roth or my 401k, et cetera, then you may not be able to afford this, okay? So that's a serious consideration. Another one is, well, let's say I do have enough, but I have a spouse, and the cost of care, if I do need it, again, the big ifs, okay, might deplete those assets because, again, at a clip of $50,000 to $100,000 a year, that's a lot of money very quickly. Over 3 years, that could be $300,000 that comes out of my retirement savings that if I need it and then I pass away and leave my spouse without that, that could be painstakingly, agonizing for that type of a situation. So these are the affordability considerations when you're doing a plan, saying, one, can I afford this now without disrupting the fact that I'm still going to live before I need it, hopefully, okay, at 65 to 70, because the average age of needing these is in the 80s, mid to upper 80s. So can I afford this without disrupting that piece of it? And number two, can I afford this or can I not afford this because it could impact my beneficiary, my heirs in a bad way if we don't have this in place. Okay, so those are the two affordability considerations. And when you do that analysis, not to get too detailed, there's a break-even point where sometimes it makes sense, sometimes it doesn't make sense. I think, Jason, you're going to get into some examples of where, how to take this consideration in a quantifiable way.
Okay, so let's look at a hypothetical of Bill and Anna. Bill and Anna are 55 years old. Okay, they're thinking about getting long-term care. So they have a policy that they're presented, and then that policy has a premium of $5,025
a year.
A year.
Okay.
Yep. And this policy would cover them for $165,000 initially, but they get an inflation rider of 3%, which means at age 85, they have a long-term care event. That amount will grow to $400,000. So what they would be covered for if a long-term care event happened, they would have $400,000 that would be able to pay for their long-term care.
So in that scenario, they've gone 30 years, if they implement this insurance policy, 30 years paying $5,025 a year, assuming the premium doesn't go up.
Right.
That's another issue that I know you're going to talk about. But if it stayed the same, it'd be $150,000, $160,000 to get $400,000 of benefit.
That's right. Okay. So Bill and Anna are nerds, and they're disciplined. And they're like, well, wait a second. Well, what if, and I'm giving you guys an example of how you should look at long-term care if you're thinking about self-insuring, and if you're disciplined enough not to touch that money and to keep it there for your long-term care needs. So if you think about that policy, well, what if we took that premium and just invested that money and it earns 7%? So you take the $5,025 and you invest that every year, and it's growing 7% over time from 55 years old all the way to 85 years old, and they didn't touch that money, you actually end up with a little over $500,000 at that time. So the long-term care policy only covered $400,000. Well, Bill and Anna are thinking, that seems like a good idea. I'm gonna self-insure because I could potentially end up with more. Now, the other mindset is there, which you just touched on, is that what you have to understand with long-term care insurance, the most recent policies in the last 10 years, they have a clause in them where they can raise the premium on you. And if you don't pay that extra premium, it's nullified. So that's something to consider too. This way they keep control over that when they're gonna self-insure. Now, the other thing to think about is, well, what if they didn't need a long-term care policy? And so, I mean, not everyone has a long-term care event. Maybe you die of a heart attack or a stroke, and it's instant. And instead of going through this big long-term care event, well, if you had long-term care insurance and you were just paying for it every month, then they may not be able to get that money. But if you had saved up in an account, then you can use that money for whatever you want, or pass it on to an heir, or your spouse can use it. So this is just, a way to kind of think through the break-even analysis, or if it would make sense to self-insure instead of paying for the premium out of pocket.
Right, like most things when it comes to insurance, peace of mind, this risk aversion, okay, guarantees versus not. Well, if I get an insurance policy, there's more of a guarantee because I'm not banking on 7% return, which may not do. Okay, there's no guarantee of that. At the same time, an insurance company might raise your premium, but maybe you just have the 165 up front, and that guarantees that. So there's different ways to look at this, and the goal here is not to tell you what you need to do, but to equip you with enough tools and considerations to say, well, does this make sense for me or my partner and I, etc. So if this is helpful, please like and subscribe to this video for future videos.